Hey traders and investors, it's Serge Berger here. What I want to talk about today is a very simple and straightforward, but also extremely effective way of using moving averages to gain, to circle better support and resistance areas, i.e. reference areas for your active investing activities. Before I do that, however, let me just quickly note that every stock has its own personality, just like we as human beings do as well. So different moving averages any given stock reacts differently to any given moving average at any given point. So just because the 50-day moving average currently works as a good support or resistance area for Amazon.com doesn't mean it's going to be it's going to be doing so in the future, or that any other stock for that matter really has any significance around that moving average. So that's important to understand. But basically, what I want to go through today is a sort of tiered approach towards looking at moving averages for support and then also for resistance. So let's look at Amazon.com, and you can see I have three moving averages here. The yellow one is the top one, that's 50-day moving average. Then I have the blue one, a 100-day moving average, and the red one is the 200-day moving average. Okay, so if we just look at this most recent period here, we're in on the 30th of January, Amazon.com broke through its 50-day moving average. So from my point of view, for my trading and investing activities, I saw that as a pretty good sign that the stock is going to move towards the 100 moving average. And I guess it did that all in one day. Okay, so at that point, then the next support area of any real significance really becomes the 200-day moving average. Okay, so from my point of view, there's two things that can happen here. Either the 200-day moving average keeps going higher over time and we consolidate sideways, or the stock actually goes down and touches the 200-day moving average as a next downside target. So you can see that after slicing through the first moving average, the next target becomes the 200-day moving average, and then the target below that is the 200-day moving average. Um, so that's an example, very straightforward. But also, if you follow this a little bit for a few months, you'll start to see this type of action very clearly in some of the stocks that you follow. Again, you may have to use different moving averages, but you'll see this type of activity happening. Then the example on the long side I can give you is BlackBerry. Okay, and BlackBerry, of course, we all know has been a very beaten down stock over the past few years, and it started to sort of show some pretty good signs of life in December. And as it started breaking out of some mini resistance areas, it started moving into its 50-day moving average here in on the 20th of December of last year. At that point, once it broke above that, my personal next attraction area or resistance area became the 100-day moving average. Again, that's the blue line right here. And after that, once it went over that, my next target area became the 200-day moving average. And you see that was all accomplished in a matter of a couple of weeks after that. So the example on the long side is the same as the example on the short side. Understand your stocks, understand which moving averages on average work well for any given stock, and then see that a push above the first moving average gets you a target at the next one, just like if the first one breaks, then the next one below that becomes support. Hope this makes sense. As always, if you got any questions, you can tweet me at my Twitter handle, which is SteadyTrader. Take care.